Welcome back to The Explainer. So glad you're here today because, wow, we have an absolute high-octane masterclass lined up for you. If you're prepping for your ACCA exams, specifically Business and Technology, BT, you are 100% in the right place. Today, we're taking a laser-focused look at a concept that's literally the bedrock of modern business law and accounting. We're talking about the company. We're going to strip away all that confusing jargon, look straight at the syllabus requirements, and make sure you have the exact, high-yield takeaways you need to walk into that exam hall with total, absolute confidence.
But, before we get bogged down in the dry definitions, let me hit you with a really high-stakes scenario out of the gate. Imagine this. If your business goes bankrupt, do you lose your house? I mean, it sounds like a simple yes or no, right? Common sense might tell you, well, yeah, if I own the business, obviously I'm responsible for its debts. But the law? The law sees it very, very differently, depending on the structure you've set up. Honestly, the single question is the dividing line between personal ruin and protected investments.
So let's get into Section 1. What exactly is a company? To answer that question about losing your house, we really need to look at how the ACCA BT 1 syllabus strictly defines the whole concept of a company. And here's your foundational definition. A company is a separate legal entity owned by shareholders. Now, I really want you to focus on those first three words, separate legal entity. This is the absolute core rule. The company is completely distinct from the people who created it and the people who currently own it. It's almost like, well, it's an artificial person created by law. And because it's completely separate, the company just keeps right on existing, even if all the original owners sell their shares, or, if the owners change completely. The owners come and go, but the company itself, it remains. Which brings us to this golden rule. In a company, ownership does absolutely not equal management. The shareholders, they're the owners. They provide the cash, the capital, but they are not the same as the people managing the day-to-day operations. The owners elect a board of directors to keep an eye on things, and then those directors appoint the management team to actually execute the plan. Now, this separation is absolutely crucial for your exams because it creates what we call the agency problem. That classic conflict of interest between owners and managers. But for right now, just cement this one fact in your brain. The owners and the business are not the same thing.
All right, moving right along to Section 2, Separate Legal Entity Explained.
So we know a company is a separate entity, right? But what is that actually allowed to do out in the real world? Well, because the law treats the company almost like a living, breathing person, it can do three core things entirely in its own name. Number one, it can own assets. That big factory, it doesn't belong to the shareholders, it legally belongs to the company. Number two, it can take out loans. The bank lends the money to the company, not to the owners. And number three, it can enter into contracts. When an employee gets hired, their contract is with the company itself. So the company essentially lives its own legal life. Pretty cool, right? Which leads us perfectly into Section 3. Limited liability protection. Okay, so if a company takes out loans and enters contracts in its own name, what happens when things go horribly wrong? This brings us to, honestly, what might be the greatest invention in the history of business, the incredible financial shield known as limited liability. Here's the deal. Shareholders lose only their investment, not their personal assets. Let's say you invest £10,000 into shares, and then the company borrows £1 million and goes completely belly up. Your maximum possible loss? Just that £10,000. The creditors absolutely cannot come after your personal house, your bank account, or your car to settle the company's massive debt. It is the ultimate protective barrier. And this brilliantly illustrates the ultimate takeaway. Just lock this formula in your head right now. Company equals separate entity plus limited liability. That is the exact one-line summary directly from your syllabus notes. If you're sitting there and you see an exam scenario trying to trick you into making an owner personally pay for a company's standard debt, just pause, take a breath, and refer back to this exact formula.
Okay, Section 4. Let's look at a case study, the incredibly famous Solomon case.
It's one thing to read about this theory in a textbook, but let's actually see how it works in a real court of law. Let's walk through the chronological drama of the landmark Salomon versus Salomon & Co. Limited case. So first, Mr. Salomon incorporated his bootmaking business. He owned almost all the shares, so it was basically a one-man show, right? But legally, it was a registered company. Second, the company hit some really hard times and went into liquidation, owing a bunch of money to creditors. Those creditors looked at Mr. Salomon and said, hey, this company is just you in disguise. You need to pay us from your own pocket. But step 3? Well, step 3 is where history was made. The court ruled that Mr. Salomon was actually not personally liable. Even though he ran the whole business and owned the shares, the company was a completely separate legal person.
So let's lock in the precedent established by that historic case with another quick one-line summary. Company equals separate legal person, distinct from owners. Seriously, no matter how closely an owner is involved with the limited company, that corporate veil stands firm. The debts of the company belong to the company. Full stop.
All right, let's shift gears slightly. Section 5, public versus private companies.
Okay, so we totally understand what a company is now, but let's distinguish between the two main flavors of limited companies you're definitely going to be tested on. On one side, we have public companies, or PLCs. Their shares are traded publicly on a stock exchange, which means ownership is incredibly wide. Literally anyone can buy in. But because they're taking in public money, the regulation is extremely high. On the flip side, we have private companies, or LTDs. For these guys, share trading is strictly restricted. You usually can't just sell your shares to some random stranger without getting permission first. Ownership is limited to a smaller, much more controlled group, and because of that, the regulatory burden is way lower than a PLC. Now, I want to pause right here and warn you about a massive, very frequent exam trap. The examiner absolutely loves to throw a scenario at you to see if you're going to confuse a stock exchange listing with general private ownership. If a scenario talks about a company with a large number of investors, do not, I repeat, do not automatically assume it's a public company. The absolute key trigger word for a public company is that its shares are listed on a stock exchange. And the key trigger for a private company? Its share transfer is restricted.
Let's reinforce this crucial distinction with one final punchy little summary to memorize before you walk into that exam hall. Just say it with me. Public equals listed. Private equals restricted. Keep that front and center in your mind, and I promise you won't fall for the examiner's tricks.
Almost at the finish line. Section 6, the ultimate exam summary. We have covered so much ground today, really quickly. So let's rapidly summarize the exact traps the examiner is literally hoping you will fall into. Number 1, assuming owners and the business are the same thing. How do we fix it? By remembering the Salomon case, they are legally separate. Number 2, confusing listing with ownership size. Fix it by remembering that only public companies are actually listed. And number 3, ignoring regulation differences. Just remember that public money always equals heavy public regulation. Avoid these super easy mistakes, and you are securing yourself some really easy marks. Before we go, I want to sign off with this final, kind of provocative thought on the realities of what we've just learned. Is the corporate veil always fair to creditors? Think about it. If a company collapses and the owners just walk away with their personal wealth totally intact, suppliers might be left entirely unpaid. But remember, in the business world, this isn't some ethical flaw to sit around and debate. It is a known, accepted legal and commercial reality. Because creditors understand this exact risk, they adjust their terms, they demand higher interest rates, or they might even ask for personal guarantees before they lend to smaller companies. It's a whole system built on calculating risk. Keep that commercial reality in mind as you conquer your exams. Thank you so much for joining me on this explainer today. Stay focused, keep studying, and I will see you next time.